There's no such thing as a passive investment. If you value the money that you earned and if you value what you're doing, you're always going to be checking up on that asset sponsor because people want to build wealth.
The more rental properties or real estate you buy, the harder it can be to qualify for loans.
You don't have to be a billionaire to do this.
I think it's such a fantastic tool where you get power and control of your own retirement funds, which you've worked hard to build.
Retirement, it has to be in layers. It's not just one thing.
Welcome back to the Hybrid Real Estate Professional Podcast, the show where we help you build a life of abundance through real estate and small business investing without compromising what matters most to you. Today's guest is Kaaren Hall, CEO and founder of U Direct IRA Services, founder of Orange County's Real Estate Investor Association, and one of the most respected voices in the world of self-directed retirement accounts. Since 2009, Kaaren has helped thousands of investors take control of their retirement funds and use them to invest in real estate, private lending, and other alternative assets. She's also the author of Self-Directed IRA Investing, published by Bigger Pockets, and a regular speaker at industry events like BPCon.
Mm-hmm.
Beyond her business success, Kaaren is a generous leader who uses her platform to give back. She serves on the board of the Council on Aging, Southern California, and supports causes that help others build stronger financial futures. Kaaren holds the keys to life-changing knowledge about how to take control of your retirement accounts and start investing on your own terms. Kaaren, welcome to the show.
Thank you, Aaron. I really appreciate it.
Selfishly, I'm really looking forward to learning a lot more about one of the best tools available to real estate investors, which I myself have not utilized yet, retirement accounts. But before we get into the technical stuff, would love to just get the Cliff Notes backstory on how you got into real estate.
How does anybody get into real estate? You start doing something else and you think, I want to make some real money. And how do I build actual wealth? And you find real estate, or it finds you, either way. So that's how it was for me, because for a while I was a radio announcer, and that's what I did. I started in college and just kept going for a long time. But then again, unless you're doing the morning show or something like that, what didn't really pay very much. And so then got into the real estate space, and that was some time ago. Moved to different things, was an actual realtor, did mortgage loan servicing, loan origination, and other things, property management too. But then Great Recession, right? And I had to I couldn't be a loan officer. I wasn't going to sell real estate then. So I got into this self-directed space. And after a couple of years of that, I opened my own company. So that's U Direct IRA Services.
Wow. Yeah. So you've really hit across all the different domains. You did lending, you did property management, you did transactions as an agent. What was, I guess that was a lot of exploration and seeing what you like and what you don't like. And then, like you said, the economy kind of decided for everyone when the downturn came, some tough decisions had to be made. But in that pre-recession chapter, was there any one particular domain that you worked in that you enjoyed more than others?
I don't know. I enjoyed them all differently for different reasons. Radio was fun, and I got a lot of free tickets to go do fun things like a whale cruise in Seattle, things like that. It's super fun. That's much different. But when I got especially more into mortgage loan origination, that was really such a deep education, because that's when I read Think and Grow Rich. And it's like, wow, this is how I do it. It was boom. It just, the whole thing, I could see it. If I do this, I can do this. And I can get from here to there, and I could see the path. And with the loan origination, it was really a path to making the best money I ever made up to that time. And I learned so much, all the jargon, but also about the professionalism, and also looking at the 1040s of the people who were getting mortgages. How are they acquiring wealth? What's on their tax return? And what do I need to do? How do I emulate, be successful people? And so that taught me a tremendous amount. So loan origination was like, what do you call boiler room? But at the same time, great education about finance and just the whole world of money.
Yeah, no, I bet you get a whole, there's the story people tell in public, and then there's what's on their actual applications and how people get approved for loans, how they continue to qualify for financing, especially the more rental properties or real estate you buy, the harder it can be to qualify for loans. So I'm sure you learned really behind the scenes how to make it all add up. And I think of it as kind of like skill stacking, right? Like you spent time as an agent, so you learned how to communicate with whether it's investors or normal kind of home buyers, and then loan origination. And I'm sure that informed you very well into what you got into, which is the insurance or the self-directed IRA space.
Well, it did
So
perfectly because what do the people that open IRAs, what do they invest in? It's real estate. And if it's not single family, it's multifamily, or they need, and they're building wealth. So mortgages are a path to wealth building, and to understand how that works. So yeah, it's all been wealth building for a long time. And so it just dovetailed really.
yeah, absolutely. So you mentioned that the recession was kind of a line in the sand, maybe a turning point. Can you talk
Yeah.
about kind of so I think I saw you founded UDirect in 2009.
Yeah.
So what was that period of kind of 2008, 2009 like? It sounds like you did some self-reflection, some
Oh,
discovery,
yeah.
and then came out of it with a great business that still exists today.
No, it was pretty crazy. So at that time, single mom, 2 kids, lost my job and mortgage. Like, okay, what are we going to do here? So it was just one foot in front of the other and sort of put it together. When I opened UDirect, I had a negative net worth, yay. And I quickly corrected that, but it was a minute. I think we all had a minute during the recession where we learned things, and we learned it was survival. It's like, what do I do? How do I take all my skills? Because you're right, I literally was skill building. One thing that I really wanted in my life is never to be stuck without enough skills to get a job, to always be employable. But now I'm an entrepreneur, so now I'll never be employed again. It's great. Now I'm totally unemployed, and I love it. And it's a great way to really help people understand what they can do to build wealth, and also not just. So it's like serving two functions. One is having wealth today so you can live a good life. That's beautiful and wonderful. But it's also building wealth so that when you can't work, that you've built something for yourself that's there for you for later. And that is incredibly important. It's important to me for myself. It's important to me to help other people to understand this and to be prepared.
Yeah, there's a huge education component because what's interesting is I've always thought of liquidity versus illiquid investments. So real estate by nature, once you buy a property, if you tie up a large chunk of your
Yeah.
equity in the home, it can be relatively inaccessible compared to stuff like stocks. But there's another element that I haven't thought as much about that I'm sure you think about all the time, which is the retirement account wall. Most
Right.
people contribute to a retirement account in some form or another through their employers, but not a lot of people spend time thinking about where that money's going. And in a way, it is also illiquid, or at least there's a penalty to
Yeah.
access it. So I guess the question that leads me to is when you're working with investors, especially maybe people earlier on in their careers, how do you educate them on kind of like what belongs on which side of the retirement wall and how to think about that accessibility of their money?
Yeah, so I should say that we're not financial advisors, just
Sure.
like for the lawyers. Don't give financial advice. We're not CPAs or attorneys or anything like that. We provide self-directed IRAs, but there are two walls, right? There's the personal wall where you're going to be using the money for put bread on the table, pay your mortgage, whatever you're going to do personally. Then there's retirement money, which is tax protected. It's in a special bubble, and the whole point of this money is to save for later. This is the later money. So you're right. I like how you say wall then, because it should be. It really should be. I mean, sometimes we need to break the piggy bank. I get it. That'll happen with a lot of people's 401ks, but which reminds me that with a 401k where you work, or a self-directed, say, solo 401k, if you're self-employed with no full-time employees, those kinds of accounts actually let you break into them without breaking the bank, because you can take a planned loan from those kinds of accounts of $50,000 or 50%, whichever is greater. And you have to pay the account back over 5 years. So there's still a way you can have personal access to those accounts. But with a regular IRA, you're absolutely right. If you break the bank, you're going to have taxes and penalties if you're under a certain age, 59 and a half, and so forth. So, but I think when you invest using a self-directed IRA, the reason you're doing it is for the intention of saving for later, with the intention of this is not my today money, this is my later money. So when you go into it with that in mind, you're going to be looking for asset classes that are going to meet your objective. And so that's what we do. We help people to actually do that and to understand how it works and how it doesn't work and what the rules are, because it's pretty important.
Yeah, I think there's kind of layers to it, right? One is figuring out and understanding how much money you might need to save for retirement to
Uh-huh.
live the lifestyle that you want to live. That's kind of more of a calculation of how much to contribute. But then where I think a lot of people stop thinking about retirement accounts is, okay, I've set aside my 15% or 20%, whatever the number is, and it goes into my employer 401k. and it gets invested in some target fund that I don't really understand. It
Right.
just has
Yeah.
some retirement year attached to it,
Yeah.
and you just don't think about it, right? I'm guilty of that. I think a lot of people probably just kind of trust that these target funds are built to optimize for whatever retirement year, but really don't understand what's inside them. And what
Right.
you provide is a way for people to self-direct their investments, and they can do things, lend private loans or
Yeah.
invest in syndications. Right? You're going to educate me. This is the part where you're going to start educating me on all the different options available to people. But I think with that comes also a responsibility. Once you have self-directed, you need to understand the risks of all the different, you're taking control of that. So you're kind of in control of your own destiny in certain ways that you might not be if you just relied on that target fund. So if you have any thoughts around just that kind of responsibility that it takes to run an account like that too.
You're going to be investing in the future. We say invest in what you know best. So for somebody like me and like thousands and millions of other people in America who are in the mortgage industry, you understand notes. For one thing, you probably also understand real estate. So real estate and notes, and then also syndications, which we can get into, kind of a hybrid of all those. But if you understand a mortgage, if you understand notes, well, a lot, that's what our account holders invest in, right? So and this was, by the way, really helpful in a grassroots level of like raising people back up after the Great Recession, after COVID. A lot of people lost businesses, and how are they going to get back? So a lot of self-directed IRAs invested in these, businesses to help people build themselves back up after an economic downturn. Because like my IRA, your IRA could have a debt or equity position in someone's business, make a loan to them, or be an equity partner in that as well. Then there's syndications. That's the number one asset class. Something to learn about. What a syndication is it's really an agreement, and it's a way for people who are raising capital to legally raise that capital. So it consists of an operating agreement, subscription agreement, which is really the contract. And so that's the paperwork. But what you're investing in is an underlying asset. It could be multifamily or, whatever. It could also be self-storage. It could be lots of different things, business buildings, strip malls, that kind of thing. So there's an underlying asset with the syndication. So what you want to do is really, if you're investing in syndications, is really dig into two things. One is, well, the person raising capital, how are they doing? You want to check them out. It's really three things. You want to really review the document. What does it say? Because most syndications don't have a guarantee of paying you back. So the third thing you really have to also analyze before you invest in the syndication, especially with retirement money, is the underlying asset. So you're going to, understand, well, okay, say it's a multifamily building. Well, what market is it in? How's that market doing? How's the employment base in that market? So there's research to be done on different levels so that you educate yourself. You make an investment based on what you've learned from your research, and then you self-direct. Because when we invest eventually in a mutual fund or something like this, we don't know who, even the person who's in charge of that. I assume it's not typically one person. I'm sure it's the committee of sorts, but who knows how to calculate a PE ratio? Seriously. So do people really know stocks, bonds, and mutual funds better than they know real estate and notes? And that's when the self-directed IRA piece comes into play.
Yeah, I think it's such a fantastic tool. And the cliche Spider-Man quote, with great power comes great responsibility, comes to mind, where you get power and control of your own retirement funds, which you've worked hard to build and contribute to. But there's also the responsibility, like you said, of really knowing who you're investing with. If you're doing a syndication, do you understand who the sponsor is? Do you understand their business plan, the market they've chosen? And also, do you understand the mechanics, right? They might have a rock solid business plan, but if they have a structure that's not going to work for you, the distributions don't start until year 3 or 4, and you need, well, I guess in retirement, you probably don't need cash flow right now, but there could be different things in the way the deal's structured that might not align with your goals. And so that responsibility does ultimately fall back to you. So I think it's an incredible tool, but then you have to be willing to be a little more active with how you do due diligence on the things that you do choose to invest in.
I love that you were that active, man. I just love that because, well, like a friend of mine, someone who I know, she invested with the self-directed IRA and it didn't go well for her. She didn't discuss it with me, which we're friends. She just talked to me, but it didn't go well for her because she thought, oh, it's a passive investment. Oh my gosh, if you're going to take something away, there's no such thing as a passive investment. All it means is that you're not talking to the tenants, you're not building the building, you're not toilets, termites, and tenants, you're not dealing with that. But there is no passive investment. if you value the money that you earned and if you value what you're doing, you're always going to be checking up on that asset sponsor, getting the reports, looking at them. Is this performing as it's supposed to perform? And do you have the right to look at financials? How is it doing after you invest, after you do your initial due diligence? Is it continuing to perform? So we talk about active investments. Well, they're all active because we have to keep on top of all of our investments to make sure that we're minding the store, so to speak, right?
Yeah, I shy away from using the P word because I think it's a very misleading in
Yes.
many real estate books and all that. And, there is such a thing as passivity, but I think truly passive, 100% passive income more or less doesn't exist because at some point you're making a decision, you're doing due diligence, or like you said, you're doing follow-up and seeing things through. One interesting element of that, though, that I really appreciate about having something like a self-directed IRA or investing in syndications, if you're an investor yourself and you're on a journey to grow and evolve, investing in other people's deals and watching how they build their business plans, having that consistent quarterly communication. So again, there's the way people talk about their projects on the internet when they're just musing on Instagram, but then when it actually rubber meets the road, those quarterly updates where maybe they had to make a difficult decision or a pivot in the way they approached it, like these are incredible learning opportunities too. And I've invested passively in a couple of deals, and now we're actually putting together our first syndicated offering. And the lessons I learned as a passive investor really informed how we approach communicating and even structuring the deal that we put together. So there's, tons of educational benefits in addition to whatever financial outcome you might be looking
Well,
at.
so you're putting together the syndication or this deal now. And so one thing I'm sure you learned is get fixed debt, right?
Yeah.
Because we've had a lot of black swans. I mentioned the recession. I mentioned COVID. Well, what about the rates going up in 2022? So one of the things that self-directed IRA world that you need to know is that if there are any expenses of the IRA-owned assets, those expenses have to be paid for by the IRA. So in the case of syndications, a lot of our account holders had capital calls. And we almost never saw a capital. I've been in this business about 20 years. We rarely saw capital calls like we did since 2022, mid-year 2022, I would say. And so it's one reason why you want to leave idle cash in your IRA account, because whatever asset you have, if it has an expense, the IRA has to pay that expense. And so that was one black swan that I'm sure you learned from, right?
Oh yeah, absolutely. So we're using an SBA loan for our project, and there's no balloon payments or anything that's going to force refis at inopportune moments. And yeah, we definitely saw a lot of projects that had that floating rate debt, and it was like a time bomb.
Yes.
And know a lot of investors that had capital calls, and that stuff. I take it very seriously. The idea of being a steward of other people's money. I know just about any operator hopefully does that, and if not, they should take it seriously. But it's a big responsibility, and I think from the other side of the table, as an investor looking at an operator, you have to basically make a judgment call. Like, do I trust this person even if they have a great deal? A bad operator can ruin a great deal if they're not responsible, detail-oriented, and have command and control over the situation and able to make decisions. So it is a big thing to try and evaluate, and especially if you're a newer investor and you don't necessarily know what to look for. Today's episode is brought to you by the Remote Real Estate Academy, the community I launched last year where I personally coach investors and empower them to buy rental properties anywhere in the United States. My business partner Nathan and I have a collective 15 years experience with over 20 cash flowing out-of-state rental properties. We provide a step-by-step playbook on how you can build your own portfolio and start accessing the life-changing benefits of real estate investing starting today. Go to remoterealestateacademy.com for more info, or better yet, shoot me an email at aaron@aaronamin.com with subject line RREA, and I'll throw in a special bonus for podcast listeners who join the Academy. Now let's get to the show. It's one thing I've noticed too about your company and even some of the others I've seen. There's a ton of education, right? A lot of these custodian and self-directed companies put on webinars all the time. They're showcasing like how to analyze deals, and I find that really valuable. It's a great asset as well. I think I'm interested to know, because like you and I, we run in real estate circles. We're around a lot of people that are actively doing this on their own. Do you find a lot of customers that are just working W-2s, don't really have an active interest in building a business, and they still want a self-directed account, or what's kind of the mix that you find?
Yes, because people want to build wealth, right? And they're looking for ways to build wealth. And now with the internet exploding more and more every day, more information out there. It's like, how do I do this thing? And then maybe it's a meetup. Maybe somehow you've heard about something like I've been active in Bigger Pockets, and we published the book, Self-Directed IRA book. Bigger Pockets is one of the ways that people have found alternative assets, but there are just so many different ways. So you start looking. It's like, I'd like to build wealth for my family. How do I do this? Well, alternative assets are going to come up at some point, and then you're just going to dig into that and learn more. Does that address your question?
Absolutely. And I think, so you held up your book. I know we'll make sure we link to that. I've been reading through it, and it's a great guide, tons of information, very comprehensive overview. I know we can't pack all that into this interview, but I'm wondering at the highest level, if we can just talk a little bit about the types of accounts, because obviously there's a big difference between a solo 401k, a SEP IRA, and the various types of self-directed. So maybe just a quick overview of the menu of options people might have.
I think you can break it down into two categories. Are you self-employed? Are you not self-employed? So if you're not self-employed, then you can have a traditional IRA or a Roth IRA if you're not self-employed. And these accounts have, for 2025, have a contribution limit of $7,000 if you're under 50, $8,000 if you're 50 plus. The $1,000, the difference, they call it the catch-up contribution, because you're a little older, you need to catch up. And
those are the same limits as a traditional IRA that's not self-directed, correct?
That is a good point, because guess what? An IRA is an IRA. Whether it's self-directed or not doesn't make a difference. This is a good time to tell you that this is the 50th anniversary, the 50th birthday of the IRA, and it's always been self-directable. Not really a different thing. It's just, what are you going to put in that bucket? A typical IRA, it's stocks, but a self-directed IRA, it's alternative assets. But an IRA is an IRA. It's the same thing. The rules are the same. The tax codes are the same. It's just a different asset in that bucket. So there's the traditional and the Roth, which is really the newest kind of retirement account for individuals. Even that is years old. But if you're self-employed, there's the solo 401k. Now, a lot of us have worked at jobs with the 401k. We know what this is. It's a retirement plan. Solo 401k or any 401k has two buckets, the employer portion and the employee portion. So if you're self-employed, you're both. And so the cap to contribute to a solo 401k is the lesser of 25% of your income up to a cap of $70,000 a year. Can possibly be tax deductible. Talk to your tax person so you could put that money away, give tax break now, and then you'll pay tax on it later when you retire. So that's the solo 401k. So you've got that. You could use that employee portion as Roth and put money after tax in. Then it comes out tax-free. That's great with the solo pay. Also, again, you can borrow money from it if you needed to. And lots of bells and whistles with that kind of plan if you're self-employed. Now, another one is a SEP, a simplified employee pension. That's, most of these things are acronyms, right? So simplified employee pensions. And now this is if you have a company with employees, you can have a SEP, and the SEP can be in effect for all of your employees and all the companies you own. A lot of people are buying businesses these days, like buying small businesses from baby boomers who are retiring. So a SEP IRA could be for all your businesses. It's called a control group. And again, the contribution is the lesser of 25% of your income up to a cap of $70,000 for this particular tax year. So I'm talking about a lot of numbers and things like this. So it's a good time to mention that before you jump into this and make these decisions, discuss this with your competent tax advisor, because it's a team. You want them on your team. Hey, I'm going to be doing this. How much can I contribute? What is my correct 25%? Like, which one should I choose? Which account type is best for me? These are questions you ask your tax advisor, and they're going to be your partner in this. They're going to make sure you get your tax break. They're going to put that on your tax return to make sure that really happens. And so they're going to be on your team with you, helping make these accounts work to your highest advantage. So we covered the traditional, the Roth, SEP, the solo pay. There's a simple IRA. Of course, it's not simple because that's what the government calls it, right? Savings Incentive Match Plan for Employees. It's an acronym. And it's not very popular. We hardly do them at all. It's just, the SEP just is so much better than the simple IRA, but they're around. And then there's also an HSA. You could self-direct a health savings account. So if you're working somewhere, that gives you the option to have a high deductible health plan, HDHP. You can have a health savings account that goes with that. And you can use that health savings account to invest in alternative assets, self-direct, right? And what else is there? There's also an inherited act. Someone passes away, and you receive their retirement account, and so that can also be self-directed.
I have so many questions, but that was a great overview. So a couple
Yeah.
clarifying things on the solo 401k and
Uh-huh.
then also the SEP IRA.
Uh-huh.
So a solo 401k, you mentioned you have to be self-employed. A lot of people, such as myself, hence I told you at the top I was going to be a little selfish and get some answers for myself too here,
Right.
but my
Fast.
wife and I have an S corp, right? That it pools. I have some coaching income. She does some consulting. We have various forms of real estate income pooling into there, but I still have a full-time W-2 job.
Uh-huh.
She is going to draw a salary from that S corp, but technically she's fully self-employed. My question to you is, A, I'm assuming she can qualify for a solo 401k, but B, could I am I disqualified from that option because I have a traditional employer?
Yeah. So two things. I'll answer your question. The other thing is talk to your tax advisor. This is a tax question.
Yes.
Right. So here's the thing. So say your wife has a business. If there's a business where you're both the owner, right? Whether you have a 401k, a W-2 job on the side, you're still the owner of this company. This company is the sponsoring company of the plan. The plan sponsor is the company. So if you husband and wife are both owners of that company, you can both participate, but you want to talk to your tax advisor, making sure that you're making the right contributions. So,
Got it. And then for the SEP IRA, did I hear you correctly that it has a similar contribution limit, which
it
is
does.
higher? It's not constrained by the $7,000 per year
Right.
that a traditional IRA is. It was the 25% or 70,000, whichever's
Yeah.
greater.
Exactly right. Yeah. The SEP IRA, think of it like a traditional IRA on steroids. But hey, here's something new and not new. At the end of 2022, this is kind of a mind blower, really, for me. I can't believe everybody isn't jumping on this. But at the end of 2022, the Secure Act 2.0 passed, the last minute of 2022. All right. At that time, what the Secure Act 2.0 said is that you can now make Roth contributions to SEP accounts, SEP and simple accounts. So say, for example, you make enough money, you could put in $70K a year into a SEP IRA, a simplified employee pension. You could do that with pre-tax dollars, get a tax break, perhaps talk to your tax person. Or you could put in after-tax dollars and have that money go tax-free for life, Roth-type dollars, into a SEP, and you've been able to do that since the end of 2022. People don't know this. You know
Incredible.
it now. You can do this, and you've been able to do it for a while. So a lot of people are like, how do I stuff a Roth with tax-free dollars? Well, here's a new way. You probably heard of the backdoor IRA or the backdoor Roth, and all that means is you contribute to a traditional IRA and then do a Roth conversion. And when you do a conversion, you pay income tax on every dollar you converted. Okay, so that's the way to build a Roth. Well, the same way is to have a SEP IRA, be self-employed, have a SEP IRA, and make Roth contributions to it. You could do that too without doing the backdoor IRA conversion thing. Now, I know it covered a lot. That's a lot of technical data for your audience, I'm sure is following. But that's why we're here. Like, talk to us. What do you want to do? What is your structure? And then tell us about your assets. That's the most important thing.
No, I appreciate the detail, and I think it's something, like you said, most people don't even know. I have a cursory overview. I've been reading your book, but a lot of this is relatively new information for me too, even though I've been investing in real estate for 7 years, and I've been contributing to retirement accounts for 15 years, and that's just stuff I didn't know. And it's one of those things where, again, we've talked about this a couple times in this interview. It is a responsibility, so it's an additional thing you have to pay attention to.
Yes.
Right. If you're gonna open up one of these accounts, there's no sense in doing it if you're just gonna invest in the same Fidelity target fund that you had with your traditional employer plan. So
Right.
it's like one of those things where if you make the decision to do it, you got to be willing to do that due diligence and really understand, like, how are the funds in this account being allocated? Am I too overly indexed on one asset class? Is it all on Dogecoin, or am I spreading it out and building? This is your retirement. It's your nest egg. So there is a responsibility element. And also, to your points you made a couple times, this should be personalized and discussed with your own tax professional, your financial planners, whomever you trust and whoever's on your team for your situation, because all of this stuff is individualized context. Like, taking advice from one person who has a very different lifestyle and set of circumstances, not necessarily going to help you. So I think it's helpful to hear the different tools available, though.
Yeah, think of it. When you were talking, it makes me think of like a garden. And you plant a garden, and you don't have to attend each plant every day. You can go live a life. But if you don't pay attention to them, sometimes everything's going to die. So just think of it as a garden where it doesn't require all your time. It just requires some of your attention. And it's probably a good idea to set aside time. Like, hey, this is my set aside time to focus on my assets. And I'm going to take an hour on a Saturday or something, or whatever day, whatever you want. And because this is a day I'm going to tend this garden, this IRA, or I'm going to be working over here on building my personal savings, whatever it is. But there are things we have to tend to in life. As adults, we have responsibilities. And like with great power comes great responsibility, like you said. And so your retirement future is another thing in your garden to tend to. Not every day. You don't have to, you can leave it alone for a minute, but you have to pay attention to it.
Yeah, I think my personal fear for myself would be that if I had full access to self-direct every dollar in my retirement account, that I might end up taking certain risks that I wouldn't have otherwise, just because I could, right? So I think there's some self-regulation that you really have to pay attention to, and really trusting and understanding what that money's really meant for. So, well, so we've talked about a lot of the upside, of which there is plenty for this type of investing. What about the actual kind of administrative process? Is it easy to open one of these accounts? Is there a ton of extra paperwork? Is it really expensive? Like what does it look like if somebody decides after this episode that they want to go open one of these accounts?
Well, we make it as easy as possible thanks to digitization, right? We've got a digital application. If it took you 15 minutes, I'd be surprised. Before we had a PDF form in the old days, you filled it out and it was a mess. Now it's a digital process. Click on this link on our website, just says open account, and boom, 15 minutes later, you've got a self-directed IRA account. You put the normal information in there, like if you were opening a checking account, like who are you your beneficiaries, this sort of thing. And if you're transferring an IRA, you're going to put that information in there, and you're going to mention this podcast and how you heard about it. And then you've got an account that's open. That's easy. Then you want to fund it and put money in it. So it's transferring an IRA, which you can start right when you're opening the account, contributing to it. And that depends upon your age, your account type, and your income. Or if you have an old employer plan, I should say, bring it over, and it's called a rollover. So you open the account, you tell that plan administrator, hey, bring my money over, and you fill out their paperwork, and then they send the money to the new account. So that's going to take a minute for them to do that paperwork. But opening an account and getting it funded, tops 2 weeks if it's a rollover.
Got it. And once it's open, let's say you see that syndicated offering, or you met the operator, you found the project that you want to invest in. Is it a pretty relatively simple process, from making the decision that I want to invest in this to getting the wire out and all the paperwork filed?
It really is. There's one pitfall to avoid that I'll mention is to make sure that you put enough money in the account that there's a pad for fees. So we have a $500 pad. It's your money. It's not a fee, but it's just for future fees. Leave some money in there. So if you're going to say, get into a syndication deal, like say a Reg D offering, and it's say $50K, you want to put it like maybe 51, just so there's a little money in there. Because otherwise, if you just put in $50K and don't consider fees, you're going to be short, and it's like you're not going to make your deadline, and it's going to slow you down. So just put a little tiny pad in there for fees. That is, approach it, do that. But assuming that you've done that, then you get us the documentation, we review it. We want to make sure that we're not saying if it's a good or bad investment. Okay, that's the account holder's job. It's self-directed, and that's what that means. But we want to make sure the IRA is the investor, not the individual. We want to make sure, at least as much as we can in our limited capacity or limited responsibility, but to see, is the IRA actually receiving an asset in exchange for the money? In other words, is that the agreement? Like, we'll give you this, you give us that kind of thing.
The real deal, am I actually getting an interest in this company or equity in this real estate, whatever it may be, right?
Well, here's an example. This will clear it up. Back in 2009, people were doing the thing, okay, open your self-directed IRA. I put money in this escrow account. And then when we find a property for you, right, then we'll pull the money out of escrow, and then your IRA will have the property then. And guess what? People were stealing that money because the money was just going to an escrow account, not acquiring an asset.
Yeah.
That's what I mean when I say acquiring an asset, that there's actually something like that. But of course, we didn't even talk about all the assets. You mentioned cryptocurrency, there's precious metals, there's a lot of assets. But once the money's in there and you've got enough and you've thought about the pad for fees, boom, the money is out in like 24, 48 hours, the end of the deal. And that's what people want. You want to invest, you want it to be as problem-free as possible. And that's why we want to talk to you and find out, what are you dealing with, so we can help you avoid the pitfalls.
Yeah, I think that's a good level of involvement, right? You're there to prevent any catastrophic, like getting sucked into potentially a fraudulent deal or something where...
Well, right, because nobody knows if it's fraudulent. Like a Ponzi deal doesn't happen when you open the account. It doesn't happen when you invest. Like a Ponzi deal happens when somebody like robs Peter to pay Paul. And that happens way after you've invested. And it's beyond the investor's knowledge. This is why you keep doing your due diligence, right?
Right.
How is that operator using your money? So we can't protect you from fraud. There's no, we can't even protect ourselves from fraud sometimes, a lot of times. So what we have in our arsenal is due diligence. And I could go on and on about that. So.
No, thank you for that correction, because it's important, right? Like, obviously, at the end of the day, the responsibility is on the account holder.
Yes.
And there's many things, like you said, that you might not find out that are wrong about the deal that could come years down the road.
Yeah.
But I guess what I meant was, it's great that you guys have a team and people that are keeping an eye on some of that paperwork as it's being processed, because you would probably be able to spot a red flag because you see these stuff all day, every day.
Yeah.
And an account holder might have very limited or potentially no experience with those type of deals. So it's another little kind of check and balance. I understand it's not a full-fledged protection from the worst outcomes, but it's nice to have another set of eyes.
Yeah, exactly right. So even 2 or 3 reviews we're doing. This can tell you a little story. So we get a deal coming through, and an account holder, if they want to do a note modification, it happens. Like the terms of this, we're going to change the terms to this. Maybe it's a balloon, and we're going to extend whatever the terms. Well, we're looking at. And when my employees the staff brought it to my attention, like, look at this note. They just wrote on the face of the note, like, modify. It's like, no, you don't do it that way. So who is this note expert that is trying to modify a note in this way? So I look up the guy's name, and I go to FINRA, which is the enforcement arm of the SEC, right? The Securities and Exchange Commission. So FINRA has a website, and write this down. This is a good one. It's called Broker Check. And a lot of times you have to be registered with the SEC to be able to raise capital. So I went on Broker Check, and I typed this guy's name in there. Oh my gosh, internet and emails, this thing. I'm just scrolling through this email about all this stuff. This guy's he's barred from doing business, not supposed to be raising capital. And this guy's trying to modify one of our account holders' notes. Like, yeah, we got a problem here. So I saw going through all these emails or all this data, an email address. So I write to that email address, and it's FINRA, and I say, you say this, but we see this. What do you want to do about it? And they say, we want a subpoena. We want the records. So like, okay, well, I got myself into that one, but here you go. And get them all the records. And that turned into the bottom line is that person is in jail. And it was mid-Ponzi when we just happened to catch it because of that foolish mistake that they made. And so there was still money in the deal to pay back investors, not 100%, but we just happened to catch it. We're not law enforcement. We're not this, right? But we saw it, and so we had the opportunity, and we seized it, and that's what happened. It definitely doesn't happen every day, but that's an example of us looking at the documentation and saying, "What?" and questioning it and taking it a little further.
Yeah, I mean, that's the difference between having a trained eye that has experience and perspective of what something's supposed to look like and not, right? So that's where I keep coming back to this. Like, I do view it as pretty inherently risky to self-direct your own funds, because you're putting your entire financial destiny in your own control, and you can end up in situations where you're signing on with people that you don't know, that aren't as regulated perhaps as a blue chip Fortune 500 company, but at the same time, you get access to all that upside too. So I don't say any of this stuff, or I'm sure you don't tell these stories to scare people, but it's just to show this is kind of the world that you're entering when you get into some of these private equity deals and, off the beaten path. Yeah.
Yeah, exactly right. And it's an interesting story. This isn't our everyday. It's the IRAs. They're not that exciting normally. I love what I do, but it's not meant to be exciting like a thrill ride or anything. It's meant to be secure and stable as much as you can make it. So there are lots of great asset classes that you can invest in, a lot of great opportunities, but you just have to find them. And the way to find them is to talk to people. What are they investing in? What kind of returns have they seen? Like your friends, you're out to dinner with somebody, well, you start talking, what are you investing in? And how's it working out for you? And you start to learn by hearsay, and then you just keep digging deeper. And you find an asset that makes sense for you. And that's when you self-direct. When you find that asset, like, yeah, I see this, I checked it out, looks good, I'm going to go forward. But yeah, the crime fighting, that kind of thing is rare, but a fun story.
Yes, absolutely. Well, I want to pivot to one other topic that's unrelated to UDirect, but kind of related to your broader story, which is I saw you also are on the board for, correct me if I get the name wrong, but the Centers for the Aging. And you've done a lot of work with just generally supporting the population in different contexts as people grow older. So obviously UDirect helps people with taking control of their financial future and preparing for retirement. Centers of the Aging, I'm sure, focuses on completely different set of problems. I mentioned before we hit record that my wife and I are building 2 residential assisted living homes, and we're also getting much deeper into that world of senior care. And you've been in it for a really long time. We talked before we hit record, the silver tsunami and the boomer population is aging much faster than we have the capacity to support them. I'm just curious to get your overall thoughts on kind of where this is all heading. Are there trends that you're seeing or ways that people can kind of prepare for those shifting demographics in the country?
Yeah, and this is probably going to be the most helpful. And this is thinking about my own retirement. How am I going to get there? And in the retirement industry, I really better figure this out for myself, right? So it dawned on me that, hey, retirement isn't just one thing. And I know a lot of us are living hand to mouth and things are expensive. And if you live in California, we're about to raise the gas prices again. And there's always something coming up. And if you've got kids, there's no end to what you need to do. But what we also need to do is take some and put it aside. Retirement it has to be in layers. It's not just one thing. You're not going to just retire on your corporate 401k. You're not going to just retire on your self-directed IRA. You've got, think of it like this, the base level is Social Security, if it's still there when you're ready, Social Security. Then maybe you got some money in the bank on top of that. Maybe, like I worked at a company that actually gave me an annuity years ago. So I've got a little annuity that's going to come in at that point. So annuities or say of cash value of whole life, these are like layers. And what we like to do pre-retirement is have streams of income. I'm sure you've heard of that. If you're learning about wealth, it's have multiple streams of income. So that if something cuts off over here, you've got something going on over here. And that's a way to balance out your economic safety. You can do that. But same thing in retirement. You've got all these different layers. And a self-directed IRA was one of them. And then there's also your personal investments. Maybe you invested in some, say, single-family rentals, and you're renting them out and you're getting the rent, and just different ways that the money's coming in. Think about this. You don't have to be a billionaire to do this. It's just find different ways to save for retirement and not just one way. There are plenty of vehicles out there and plenty of experts to help you with that.
Yeah, it is a bit scary in the recent 5-6 years. A lot of inflation, a lot of affordability. People use the word crisis. It kind of is an affordability crisis in many markets. People can't afford the rents and just the general cost of living. So it's shifting a lot of things around while the entire population is aging very quickly. And like you said, Social Security, there's lots of other things that people have grown to depend on. That it's just a big question mark, right? Like I'm 35. I have no idea if when I'm at retirement age, that will be there. And if it is there, in what capacity. So the more we can take matters into our own hands. So I believe in rental properties. It's a great stream of cash flow, especially if it's something that you plan to buy and potentially pay off by the time you're retired. Then you do have those multiple streams of income. It can allow you to have less pressure on relying exclusively on your retirement account. There are those layers, and that's where I think the financial education is definitely really important. So
I so agree. Yeah. I so agree.
Well, if people want to learn more about UDirect or follow you, I know you speak at conferences, you've written your book. What's the best way for someone to find you if they want to learn more?
Right there, info@UDirectIRA.com. So info@UDirectIRA.com. We all get that email there at UDirect. So that way we can respond to you quickly, and that's the best way. Or follow us on social media. We're on Instagram, LinkedIn. Where are we now? Facebook. What is there? We're there. And I do a lot of reels. Well, it'll be like a 45-second little bit about something that you need to know about a self-directed IRA, because there are a lot of different little idiosyncrasies. So we're all over social media. So please follow us there.
Decades of experience and perspective, and then also specialized knowledge in one of the most powerful tools available to investors, self-directed retirement accounts. I've had a lot of fun learning about it. I appreciate you taking some time to come on the show. And we'll make sure all that stuff's included in the show notes. So
I appreciate it.
Thank you. Catch you next time. Thank you for making it to the end of today's episode. As you may know, podcasts are very difficult to grow organically. If you're getting value from today's episode, I'd deeply appreciate if you can take 30 seconds to leave my show a 5-star rating and review. This will go a long way to helping me reach more listeners just like you. Thank you so much in advance.